This is the story of a 58-year-old Indian man, a green card holder since 2014, who worked 12-hour shifts managing a Dunkin' Donuts franchise. Every single month for 9 years, he sent money home to his aging mother and his younger brother's family back in India. Around 2800, like clockwork, on the 15th of every month. 9 years without missing a single payment, until March 2026 when the payments suddenly stopped. Not because he forgot or chose not to, but because his bank account was frozen. Bank of America placed a hold on his account citing a suspicious activity review connected to a pending federal inquiry. Within 48 hours, two agents from Homeland Security Investigations showed up at the parking lot of his Dunkin' Donuts location in Woodbridge. They carried a folder containing 73 pages of documentation, every money transfer receipt, every bank statement, and his last four tax returns. The total transfers they identified came to roughly $291,000 over 9 years. His W-2 showed an annual salary of about $800. They asked him one simple question: how does someone earning around $44,000 a year send $291,000 out of the country? He actually had a perfectly reasonable and legal explanation. He co-owns the franchise with his wife, who earns her own income. He also has rental income from a small property in Queens. All of it was reported on his taxes. All of it was legitimate. But none of that mattered at that point because the investigation had already been opened. A suspicious activity report had already been filed. His name was already sitting in the FinCEN database. And under the IRS ICE data sharing agreement that was reportedly signed in April 2025, his tax return, the very document that could prove his innocence, was the same document that initially brought him to their attention. He was eventually cleared after about 11 weeks and roughly $9,000 in legal fees. But during those 11 weeks of frozen accounts, he could not pay his suppliers, could not make payroll, and could not send his mother her monthly support. His 79-year-old diabetic mother went over 2 months without receiving funds from her son for the first time in nearly a decade. This is what the system can do in 2026. Not necessarily to criminals or traffickers, but to ordinary, hardworking people running small businesses and supporting their families overseas. And the most unsettling part is that this man did nothing wrong. He never structured his transactions. He never hid income. He filed every tax return on time. He still ended up under investigation because the rules have shifted and most people have no idea. Today on US Updates Hub, Timothy is going to walk you through everything this man did not know. 5 rules, 5 potential traps, and 5 ways to protect yourself. By the end of this video, you should have a clear understanding of how the United States government may track dollars sent abroad and what steps you can take so you do not find yourself in a similar situation. Let us start with the number everyone has heard, but very few people truly understand. $10,000. Under the Bank Secrecy Act of 1970, every financial institution in the United States, whether it is a bank, credit union, check cashing store, Western Union, MoneyGram, or any other money transfer agent, is required by federal law to file what is called a Currency Transaction Report, or CTR, with the Financial Crimes Enforcement Network, known as FinCEN, which operates under the United States Treasury. A CTR must be filed any time a customer conducts a cash transaction of $10,000 or more in a single business day. It does not matter whether you are depositing, withdrawing, exchanging, or transferring. If the total reaches that threshold in one day, a report is generated and sent to FinCEN. Now here's where most people make a critical mistake. They think if they just send $999, they are in the clear. That is not only incorrect, it can actually be a federal offense. It is called structuring, and it falls under Title 31, United States Code, Section 5324. The law essentially states that no person shall, for the purpose of evading reporting requirements, break up or assist in breaking up any transaction with a domestic financial institution. The potential penalty can be up to 5 years in federal prison and fines of up to $250,000 for individuals. For businesses, that fine may go as high as $500,000. To illustrate, consider a real case from 2005 involving a convenience store owner in Texas who was sentenced to 2 years in federal prison for structuring. He made multiple cash deposits, each just under $10,000. The bank recognized the pattern, filed a report, and the IRS Criminal Investigation Division opened a case. He ended up behind bars. The lesson here is straightforward. Do not try to work around this system by breaking your transfers into smaller amounts. The detection systems are specifically designed to catch that kind of behavior. Banks are trained to identify these patterns, and if a bank even suspects you may be structuring, even if each individual transaction is well below $10,000, they can file a suspicious activity report, commonly known as a SAR, and that SAR goes straight to FinCEN. Now here's where things become especially concerning for immigrants. On November 28, 2025, FinCEN reportedly issued a new alert directed at money service businesses across the country regarding cross-border fund transfers. In this alert, FinCEN instructed every money service business in America, including Western Union, MoneyGram, and similar agents, that they should file a suspicious activity report for any transaction involving at least $2,000 if the business knows suspects or has reason to suspect that the funds may be connected to questionable sources of income. That number is worth repeating. $2,000, not $10,000. If you walk into a money transfer location and send $2,000 to family overseas, and the agent has any reason to question your income source, they may be required to file a SAR on that transaction. The alert reportedly lists several red flags that could trigger this, including frequent transfers in round amounts, transfers that appear inconsistent with the sender's stated occupation, multiple transfers to different recipients in the same geographic region, use of multiple locations that might suggest an attempt to avoid detection, and incomplete or inconsistent identification documents. Think about how many of those indicators could apply to perfectly law-abiding immigrants who simply send money home on a regular basis. Someone driving for a rideshare service, working in construction, or employed at a restaurant, sending $1,500 to $2,500 every month. To an automated system, that pattern can appear suspicious even when it is completely legitimate. And here's the critical connection. That SAR does not simply remain in a FinCEN database. Under the Patriot Act and subsequent directives, SARs can reportedly be accessed by hundreds of federal, state, and local law enforcement agencies, including ICE, Homeland Security Investigations, and the FBI. Now we reach the development that many consider the most significant shift in 2025. This is where the IRS, traditionally a tax collection agency, reportedly became connected to immigration enforcement in a new way. In April 2025, reports indicate that Treasury Secretary Scott Bessent and DHS Secretary Kristi Noem signed a formal data sharing agreement between the Internal Revenue Service and Immigration and Customs Enforcement. Under this arrangement, ISA can reportedly submit names and addresses of suspected individuals to the IRS, which then cross-references those names against its taxpayer database, including W-2s, 1099s, and tax returns, and may send back confirmation of identity, address information, and employment data. According to reports, in the first batch alone, ICE submitted approximately 1.28 million names to the IRS. The IRS reportedly verified tens of thousands of those individuals and shared their information with ICE. In May 2025, a U.S. district judge reportedly denied a request by advocacy groups to block this data sharing, ruling that the shared information did not fall under certain IRS privacy protections. Then, in early 2026, reports emerged suggesting the IRS may have inadvertently shared taxpayer information beyond what the agreement originally authorized. So consider what this may mean in practice. You file your taxes as the government instructs you to do. You report your income. You may use an ITIN number because you do not have a social security number. And that very same tax return could potentially be used to identify your employer, confirm your address, and share that information with immigration enforcement. This is based on court documents and official reports that have become public. On top of this monitoring framework, there is a relatively new tax that applies specifically to money sent abroad. Legislation reportedly signed into law includes a provision imposing what may amount to a 5% excise tax on certain remittance transfers sent from the United States to foreign countries. This tax is paid by the sender. However, there appears to be an important exemption. This tax may not apply if your transfer is funded through a withdrawal from a U.S. bank account, a U.S.-issued debit card, or a U.S.-issued credit card. The tax may only apply to transfers funded with cash, money orders, or cashier's checks. Here's a practical example. If you send $500 in cash to family overseas every month, a portion of that goes to the federal government as an excise tax on top of whatever you already paid in income tax. Over years, that adds up significantly, but here's the larger concern. If you do not have a U.S. bank account, perhaps because you lack certain documentation or because financial institutions have become more cautious about certain accounts, you may be limited to using cash, and if you use cash, you may be subject to this tax. Simultaneously, every one of those cash transactions could also be reported and monitored under the lower SAR threshold discussed earlier. So there is a possibility of being both taxed and monitored at the same time. The scale of this is worth noting. Immigrants in America send tens of billions of dollars in remittances abroad each year. Estimates suggest this type of tax could generate billions over the coming decade, funds drawn directly from immigrant families. There is one more layer that many people may not be aware of. In early 2025, FinCEN reportedly issued a geographic targeting order specifically for money service businesses operating near the U.S.-Mexico border. Under this order, businesses in designated border areas may be required to file reports for transactions at thresholds significantly lower than the standard $10,000 CTR requirement. This means that if you live in border states like Texas, Arizona, New Mexico, or Southern California, and use a local money transfer agent, your transactions could face even stricter reporting requirements than in other parts of the country. The practical effect is that millions of immigrant families living near the border may face heightened financial monitoring simply based on their geographic location. Let Timothy walk you through the enforcement chain so you can understand how a simple money transfer could potentially lead to a more serious inquiry. First, you send money, and the money service business files a SAR or CTR with FinCEN. Second, FinCEN's system may flag the transaction based on pattern analysis, such as multiple SARs from the same individual, high-frequency transfers, or amounts that appear inconsistent with declared employment income. Third, under the data sharing framework, ICE may submit your name to the IRS, which could confirm whether you have filed taxes, what income you reported, and what address you used. Fourth, if your reported income does not align with your transfer volume, for example, reporting $22,000 in annual income but sending $45,000 abroad, that gap could trigger an investigation referral. Fifth, an investigative unit may open a case which could involve surveillance, home visits, employer visits, or subpoenas for bank records. This entire chain can potentially begin with a single $2,000 money transfer. Timothy does not just want to raise concerns. The goal here at US Updates Hub is to help you protect yourself. Here are 5 practical steps that anyone sending money home should seriously consider. Step 1. Use electronic transfers from a US bank account whenever possible. If you have a bank account, use it for your transfers. Electronic transfers may help you avoid the remittance excise tax entirely, and could reduce the likelihood of a SAR being filed because electronic transfers from verified bank accounts generally carry lower suspicion profiles. Step 2. Never structure your transactions. Do not split a large transfer into several smaller ones. Do not use multiple locations on the same day. Do not ask family members to send on your behalf to stay below reporting thresholds. All of this could be considered structuring, which is a serious federal offense. Step 3. Keep thorough records of your income sources. If anyone ever questions where your money comes from, you need documentation ready. Keep pay stubs, bank statements, tax returns, and W-2s or 1099s organized and easily accessible. If your income is legitimate, solid documentation is your strongest protection. Step 4. File your taxes properly and on time. Timothy knows this might sound counterintuitive given what was just explained about the data sharing pipeline, but not filing taxes creates its own serious problems, including penalties, interest, difficulty adjusting immigration status, and inability to prove continuous presence. The important thing is to file correctly and to understand that your tax data may potentially be shared. Consider consulting with a tax professional who also understands immigration matters. Step 5. Consider opening a joint bank account with a trusted family member who has proper documentation. Many banks allow joint accounts. If your family member has a social security number and a U.S. bank account, electronic transfers from that account to family abroad may not trigger the remittance tax and could carry a lower monitoring profile. Let Timothy put some real numbers on this so you can see the difference these choices make. In one scenario, imagine someone without a bank account sending $2,000 per month in cash through a money transfer service. Each month, there may be a tax charge on that cash transaction plus the transfer fee, and every single transaction could potentially trigger a SAR because it meets or exceeds the $2,000 threshold. Over a year, that could mean significant tax costs plus multiple reports filed under your name in the FinCEN database. Now compare that with someone who has a U.S. bank account and sends $2,000 per month electronically. There may be zero remittance tax because the transfer originates from a bank account. The monitoring risk is considerably lower because the identity and income are verified. The annual cost might be limited to modest wire fees, with no tax burden and minimal reporting risk. The difference between these two approaches is not just about money. It could affect your peace of mind, your stability, and whether or not you ever face an unexpected inquiry. Timothy also needs to address informal transfer systems. Some communities use unofficial channels to move money across borders. Here is the legal reality. Operating as an unlicensed money service business in the United States is a federal offense that can carry serious prison time. If the funds are connected to any other legal issues, the penalties can escalate significantly. In recent government risk assessments, informal transfer networks have been specifically identified as high-risk channels for cross-border fund movements. Does every informal transaction lead to prosecution? No. But if you are already on any government radar, if SARs have been filed on you, if your name has gone through any data-sharing pipeline, and you are also found to be using informal networks, the legal exposure could multiply dramatically. The safer path is to stay within the formal financial system. Yes, it may cost more, and yes, it is monitored. But being inside the system with proper documentation is generally far safer than being outside it. Let Timothy summarize everything clearly. The $10,000 threshold is not necessarily the main concern anymore. The more immediate issue in 2026 may be the $2,000 SAR threshold that specifically targets cross-border transfers. The data-sharing pipeline between tax and immigration authorities that has reportedly already affected tens of thousands of people is a real consideration. The remittance tax that disproportionately impacts cash users is another factor, and geographic targeting orders that may create enhanced monitoring zones in certain areas add yet another layer. Every dollar you send home may now be tracked, potentially taxed, and could be shared with enforcement agencies. This is not speculation. It is based on publicly available statutes, official alerts, and court rulings that have been documented and reported. Protect yourself. Protect your family. Consider following the 5-step plan outlined in this video. And please share this information with anyone you know who regularly sends money abroad, because most people may have no idea these systems are in place. This information is presented for educational purposes only. This is not financial or legal advice. Please do your own research and consult with qualified professionals regarding your specific situation. If this video helped you understand something new, please consider hitting the like button. Subscribe to US Updates Hub because Timothy covers these kinds of topics every week with detailed research and original sources. Drop a comment below and share your experience. Are you using cash transfers? Do you have a bank account? Timothy will do his best to respond and offer guidance. Next week, US Updates Hub will be covering important information about electronic device searches at US airports, a topic that could affect every single traveler. You will not want to miss that one. Until then, stay informed, stay protected, and we will see you in the next video.